All right, let's dive into Simulations Plus, ticker SLP. They just dropped their Q1 numbers, and, well, the market's initial reaction was not pretty. But the reason why the stock took a hit, it's probably not what you'd think just by looking at the headlines. So let's break it all down. And the whole story really starts with this number right here. Almost as soon as the report came out, the stock fell nearly 5% in after-hours trading. That was the market's instant gut reaction verdict on the quarter. And that brings us to the big question, right? Because on the surface, revenue actually looked okay. It basically hit what everyone was expecting. So what on earth spooked investors so badly? To get that answer, we've got to look under the hood. You know, this quarter was truly a tale of two numbers. It's all about what they brought in the door versus what they actually got to keep. Let's take a look at those headline results. Okay, so check out this contrast. It's pretty wild. Look at the top line, revenue. They hit $18.4 million, which was right in line, maybe even a little better than estimates. So no alarms going off there. But then you look at the bottom line. Adjusted earnings per share came in at just 13 cents. That is a huge miss from the 19 to 20 cents Wall Street was looking for. And that disconnect right there, that's the whole story. So how in the world do you have a stable revenue, but your earnings just completely fall off a cliff? The answer is all about the business mix. The real story here isn't about how much money they made, it's about how they made it. And here it is. This is the heart of the problem. Their high-margin software revenue, the really profitable stuff, was down a shocking 17%. At the exact same time, their lower-margin services business grew by 16%. This is a classic mix shift problem. The part of the business that prints money is shrinking, while the less profitable part is growing, and that just crushes your overall margins. And because of that shift, for the first time, their less profitable services segment now makes up over half of their total revenue. This fundamental change in where the money is coming from is exactly why that EPS number was so weak, even though the top line looked stable. So you're probably wondering, what did management have to say about all this? Well, they didn't really dwell on the earnings mess. Instead, they pivoted hard to their long-term strategic vision. They're basically arguing that this tough quarter is just a bump in the road and the way to a much bigger transformation. On the earnings call, CEO Shano Conner framed it just like this. He said the company is becoming a fully integrated ecosystem. The message here is pretty clear. They want us to stop looking at software and services as two separate things and start seeing it all as one single, powerful platform. And they broke this whole vision down into 4 key parts. It all starts with their core science, which is already trusted. Then, they're connecting everything up in the cloud. And on top of all that, they're layering on AI, both to make their own teams faster and to build these cool co-pilots for their customers. This is basically their big strategic answer to all the short-term worries about that business mix. Now look, a grand vision is one thing, but do the numbers back it up? Does it actually translate into their financial outlook? Let's see what they're telling us to expect for the rest of the year. Okay, so despite this really weak start, management is sticking to their guns. They reaffirmed their full-year guidance. But here's the really critical detail. They're still guiding for that software mix to be between 57 and 62% for the whole year. Now remember, they just posted 48%. To get there, they are going to need a massive rebound in software sales over the next 3 quarters. That is a really bold call, and it puts a ton of pressure on them to execute. And believe me, they know they have to prove it. Management has already scheduled a virtual investor day to really lay out their strategy and their product roadmap in detail, so you might want to mark your calendars for January 21st. That is the next big show me moment, and it could be a huge catalyst for the stock. So let's put it all together. What's the call on SLP right now? Here's our official rating on the stock, plus a little trade idea as we head into that really important event. We're rating the stock market perform, and here's why. On one hand, you have this really compelling long-term vision of an integrated AI-driven ecosystem. That's exciting. But on the other hand, that's balanced against some very real, very near-term execution risk. They absolutely have to deliver that huge software rebound to hit their own numbers. After a 17% drop, the market is, very rightfully, in show-me mode. And this brings us to what we're calling our outrageous but plausible trade idea. The whole thesis is that this investor day on January 21st is a binary, make-or-break event. Management will either knock it out of the park and send the stock flying, or they'll fail to convince Wall Street and the stock could drop hard. So the trade for that kind of scenario is an options strangle. You'd buy both an out-of-the-money call and an out-of-the-money put.
It's not a bet on direction, it's a pure bet on volatility. You win if the stock makes a big move, either up or down. It's a way to trade the uncertainty itself.
So there you have it. That's the story of Simulations Plus. It's a classic battle between a really tough quarter and a very promising long-term vision. All eyes are now on January 21st to see if management can convince the market that the future is a lot closer than it currently appears. This is not financial advice.